Hello, everyone, and thank you so much for joining us today on this very special session. I'm your host, Paramita Chatterjee, and today we're going to talk about and learn a little bit more about multi-asset allocation funds. Now, these are the kind of funds which have gained a huge amount of popularity amongst investors. In fact, they've seen a blistering pace of growth as well. So we'll understand the reasons behind why investors are flocking to this category of funds. What are the benefits? What could be the possible red flags? And really to understand this entire investment strategy behind multi-asset allocation funds, we have none other than Chintan Haria, who is the principal investment strategist, ICICI Prudential Asset Management Company Limited at ICICI Prudential AMC. Chintan, great to see you. Thank you so much for joining us on this session.
Is where we probably
Yeah, go ahead. Go ahead.
Moneycontrol is where we probably end up spending a lot of our time. So it's always a pleasure to be there on live and interacting with your audience as well, and hoping that the session on multi-asset fund will enlighten them about the category. Thank you.
Well, good to know that everybody's on Moneycontrol. That's exactly what we want. But everybody is also watching this new category of funds, so to speak, relatively new. And that's the multi-asset allocation fund. Now, it seems to have become a go-to for seasoned as well as new investors. So just explain a little bit about what exactly goes behind, this particular category of funds and, what are those asset classes that it invests in?
Sure. So if we look at the category itself, and now the good part is after the 2018 scheme categorization, which the regulator has beautifully done, each category is well defined. So you have large cap, mid cap, small cap, and the regulator has the foresight of actually having a category which allows investors to participate in minimum three asset classes within a particular scheme category, which is essentially called the multi-asset category. So as the name suggests, it's a category wherein minimum three sets of asset classes are there and with an exposure of minimum 10%. Now we'll go into detail as far as what are the various options are available, but it is a one way of basically getting investments into predominantly debt, commodities, and equities into a particular category. So Indians have been investing in debt. Newly, we are seeing Indians increasing exposure to equities, and something like gold has always been a favorite among Indian investors. And if you get all three of these and much more in a single product, it could be REITs in which it could be other commodities. It makes it a one-stop solution from an asset allocation perspective for investors for their long-term wealth creation. So multi-asset fund, to put it very simply, is a single instrument which allows investors to get exposure to minimum three asset classes, which is essentially normally commodities, equities, and debt. And of course, there are other asset classes which you can add on, but minimum three, which are defined in each scheme information documents. And the only restriction is you have to have minimum 10% exposure to each of these three categories. So normally it is run in a way that there is predominant equity, then there is debt, and then there is gold, silver, which is the commodities part. And then you have REITs in which are added, but we'll go into detail as we move along. But multi-asset category, why is it becoming popular? Because if you're in a single instrument with probably efficient equity taxation, there can be different taxations which are possible depending on how you're running the multi-asset fund. But if it is an equity tax multi-asset product, then you have with efficient taxation a possibility of having three or four asset classes within one single investment, and you keep building it over time. It basically is a good investment catering to any investor's portfolio, irrespective of their risk class.
So essentially, the key differentiator, as you said, you have three different asset classes. Of course, you've got debt, you've got equity, and the third bucket could be anything. It could be commodities, it could be REITs, and so on. So we learn more about that. In fact, Chintan, as somebody who's been watching the equity markets, and you've been with ICICI Prudential for a long time, I've been tracking the equity markets. First we used to talk about balanced fund, then we talked about hybrid funds. Now you've got these multi-asset allocation funds. Exactly how would you differentiate multi-asset allocation funds from, say, the first two that I mentioned? And is there a sort of a dynamic asset allocation, as in can the fund manager, keep changing the allocations between the three buckets?
Yes, so it is interesting that you raised this because at ICICI Prudential we had a focus on hybrid as a category because we truly believe that this category will become much larger because Indians predominantly were investing in debt, and then of course as we moved along people have started investing in equity. So if a product gives you both, it ends up being a winner for the investors. Now there are many hybrid products which are possible. One is you start with from a let's say lower risk end, which is essentially equity arbitrage product and equity savings fund, where the equity allocations are low. Then you mentioned about the balanced category, which is there. The balanced category is essentially erstwhile, which is now called the equity and hybrid category, wherein you have a standard allocation of about 60 to 65 to 70% in equities. Um, Balance Advantage Fund as a category, which is also called the Dynamic Asset Allocation Fund as a category. There, the asset allocation patterns can move dynamically between 0 to 100 depending on the various models which each fund house has. And then there is this multi asset fund. So, the differentiating factor as far as these four categories is concerned, equity savings fund will typically have lower equity. You don't go higher than normally 40% in equity. Then you have the balance category where it is 65 to 70% equity, which is more or less static. The balance advantage fund, you have only equity and debt generally, which keeps moving between 0 to 100. Of course, for the equity taxation purpose, gross equity level is maintained at 65% even in balance advantage fund. And then the multi-asset fund, which is the only category where you have the exposure of commodities which are possible, and that basically adds on to the interest which investors are showing towards this category. So multi-asset fund is a fully rounded fund wherein you have rates in which gold, silver, other commodities which are possible. You have equity, you have debt. And as you mentioned, much like dynamic asset allocation, even in the case of multi-asset fund, the SIDs are flexible in terms of allowing the fund management team to take calls between reducing equity, increasing equity if they have a view that the markets are overvalued, undervalued, and increasing commodity exposure, decreasing commodity exposure, subject to the limits which are always mentioned in the investment strategy portion of the scheme information document.
Right. I think you've explained it so well. And at least I, for one, have been able to understand the benefits of investing in such a fund. And, you mentioned the word risk, and that's something that investors, and especially as they move along the age graph, are, become more and more averse to. Can you tell us a little bit in terms of the functioning of the multi-asset allocation fund when it comes to issues such as, addressing risk? What are the kind of risk adjusted returns? You also mentioned about the fact that the fund manager can sort of decide on how he or she should allocate between these various buckets depending on the market conditions. So give us a sense of how can this fund help me mitigate some of that risk and volatility, which as an investor I really want to protect myself from.
Yeah, so if we look at from an investor standpoint, the biggest risk which most investors don't probably realize is the risk of not being in an asset class in the right proportion at the right time. Now, if you choose the right asset class in the right proportion at the right time, you end up getting the benefit of that asset class and then you move to the other asset class which can do better. Now, obviously, this requires some sense of understanding of those asset classes and also it requires an active management. Most investors will obviously neither have the time because they will be busy in their own profession, nor have the understanding that what are the factors which are moving these particular which are moving these particular asset classes. And hence, the multi asset fund is a one stop solution which allows you to participate in equities, debt, rates in rates, commodities, and so on and so forth in a way that the fund management team can basically maneuver. Now, the flexibility is there across. So, within the equity portion, you can have any market capitalization, any sectoral allocation. You can reduce the equity, increase the equity subject to the limits that have been set in the particular SID of the particular fund. Even in the case of commodities, you can go as low as 10. You can potentially as high as maybe even 30 if the SID allows. So that applies to debt as well. So if you look at the flexibility which is there, it ensures that from an investor standpoint, what is the meaning of reducing risk? You reduce risk by diversification. That is basically being presented there. Diversification between different asset classes, and within each asset class also you have the potential of diversification. So in equities, like I mentioned, you can have any sector, you can have any market capitalization. Within debt, you can have any credit, you can have any government security of any tenure. Within commodities, you are allowed to have a lot more than just gold. So depending on, of course, what your SID allows. So this diversification within asset classes and across asset classes ensures that if the fund management team does a good job, your risks are contained while your wealth creation journey happens across asset classes, which is basically the biggest attraction I see that multi-asset funds have had. And because generally equity markets were less penetrated, if you look at India's roughly about 880 lakh crore savings, which is there of Indians, only about 5 to 6% comes into equities. While, of course, if you look at the same number for US, the equity allocations for the personal savings of US investors is anywhere in the range of 35 to 40%. So it is an advanced economy. We are obviously moving towards there, but the allocations of investors has to increase towards equity, and this is one of the ways in which the investors have got comfort that in the long run we are able to basically get a good exposure to equities as well in the right proportion. And markets have been supportive in the last 8 to 10 years, so that is bringing in more money towards multi-asset fund. The only issue which investors should keep in mind is that it is meant for the long term. Any investment is meant for more than 5 years, and across a market cycle, you will end up getting the benefit of this diversification, which multi-asset funds provide.
I will, ask you more questions about how, one can investors. What's the outlook, the investment horizon? But before I ask you that query, taxation. It's always there on all our minds, especially with the two categories of tax, as the short-term capital gains and the long-term capital gains. I mean, how are these typically this kind of funds? How are they taxed?
Sure. So I think taxation is a subject. I, being a chartered accountant, of course, I understand it a little better, but most people find it difficult to understand taxation. So let me just make it easier for investors to understand. When they are investing in a mutual fund in India, there are now three types of taxation. The first taxation is essentially the equity taxation, which is very well known that any category where there is minimum 65% gross equity exposure across a 12-month period, you basically have equity taxation, wherein if you keep for more than 1 year, you are taxed at 10%. If you keep for less than 1 year, you're taxed at 15% and some surcharge. That's the equity taxation part, where you need minimum gross equity of 65%. That's type 1. Type 2 is essentially now, which was introduced somewhere in March 2023 when the changes in the budget happened, that if any fund has minimum 35% in equity, that particular fund which is having minimum 35% in gross equity, they will be eligible for the benefit of indexation. So if you keep your money in any fund which has minimum 35% equity, by virtue of anything having more than 65% equity, that will be taxed as equity. We've already discussed that. But below
Hmm.
65 and above 35, then you get the benefit of indexation if you keep for more than 3 years. So let's say you keep that particular fund which has more than 35% equity, less than 65% equity. Keep it for more than 3 years, you get the benefit of indexation, much like how you have when you buy and sell houses and you have the indexation benefit. You'll get the benefit in this type 2 taxation as well. And the third category is essentially the marginal tax. So all your debt funds, all your international funds, and any fund which has less than 35% Indian equity exposure will be treated as marginal tax. So these are the three taxations which are possible. Now, the beauty of multi-asset fund is that uh, the fund management team, each asset management company can have their own view that which bucket they want to keep in terms of their multi-asset funds. So there are multi-asset funds in the category, most of them, which have equity taxation. So they will keep minimum 65% in gross equity. Generally, we believe that equity taxation is something which is beneficial to investors in the long run, but each investor will have their own way depending on what is their income, etc. The second is essentially those multi-asset funds where they have equal allocations, say 35% equity, 35% debt, 30%, let's say gold or commodities. They will have the benefit of indexation after 3 years. So there are mainly two types of multi-asset funds which are available in the market, and the investors can choose depending on what is right for them. They may require help from an advisor, as always, to choose the right product, and within the right product, in this case, what is the taxation that suits them most.
Indeed. So you've explained, I mean, some of the key figures we need to keep in mind is if it's 65% and above in equity, or is it below in that mid-range of 35 to 65% equity? Clearly, there are different tax implications. Now, you mentioned the fact that when one invests in this kind of fund, one should be prepared to stay with it for the long haul, at least 5 years. I mean, if you were to sort of come up with a profile of investor, or rather, what's the investment horizon or outlook an investor should have once he puts his or her money into this kind of a fund? What should it be?
So the good news is that in India, be it a new investor, be it a seasoned investor, everyone wants a tax efficient way of investing across categories, because you'll rarely find anyone who probably has 100% in equity. And today, rarely you'll find anyone who has 100% in debt as well. Most people have started to invest in equity. So that range of who can invest has expanded meaningfully. Let's say if you are a new investor, even in that case, multi-asset category will suit you because it will allow you exposure to all the three asset classes. If you are a seasoned investor, it will again help you because the tax efficiency means that whatever asset allocation you need, you'll get it within the multi-asset fund. So I think from an investor risk return profile wise, it suits all the categories of investors, and hence it is a category like you mentioned earlier, which is getting more and more flows. It is getting very popular because it suits everyone. Now, the reason why I said 5 years is something which you should keep in mind, because any product which has equity exposure, in this case, it can have as high as 70%, 65, 70%, 80% when markets are low, and then it can have lower if the fund management team feels. If you have that kind of equity exposure, which is possible in multi-asset funds, there is a 5 year time horizon which you should give the fund, because equities over a period of time obviously have the power of compounding. But in shorter time periods, because of what we saw, so for example, in March 20 because of COVID, or March 18 because markets became overheated, in the short run they can fall as well. In the long run, of course, we've seen along with the growth of the GDP of India, the market capitalization of companies also grows. So in the long run, you get the benefit of equity growth in line with the growth of the GDP, more or less. And if the fund management team does a good job, they can pick the right sectors and stocks, they'll give you that alpha as well. But in the short run, it is very difficult to predict what accident happens globally or in India, which basically brings down the equity portion. And if you have a less than, say, 3 or 5 year time horizon, you may end up being in a scenario where at probably a lower time in the market when something has gone wrong, if you have to access that money, you will probably not get the kind of experience that you would expect investing in equities. So keep it a 5 year window. I would say keep it more, and the longer you keep, the better it is. And the good news as far as India is concerned, which is one of the most heartening things, is that even in the last 3 days, if you look at it, we've seen 20,000 crore worth of FI selling, I think, across 2 days. The market has been able to absorb it because of the power of the domestic investors investing through the mutual funds and otherwise in the market, which is a very good thing because it is deepening the market, and it is also ensuring that it does not shake the investors in terms of their confidence in the market. So, in some sense, the domestic investors investing in the Indian markets, even a part of their money, it's not like domestic investors. Having said all of that, I think we have only about 4 or 5 crore, 4 crore mutual fund investors in India, and we've already reached 9% of India's total market cap. So the scope is quite wide in mutual funds in terms of investors. And even in DMAT, if we see, we've gone from 3 crore to 13 crore DMAT accounts. But more or less, I think from an active DMAT investment standpoint, it's not that big. So there is a
Hmm.
lot of scope in India, and we believe that that scope will ensure that this equity cult which is happening will keep growing. The only thing is you need to give time, because much in line with how equity markets work in cycles, there will be ups and downs. And new investors, especially because they've not probably experienced a very sharp downfall. Now it's been almost 3.5, almost 4 years since the COVID downfall. People probably have forgotten what it means to see a big downfall in the market. So the word of
Right.
caution is that keep them in mind. That's very important.
Indeed, I'm glad you brought up that point because a lot of us who were invested during that whole pandemic period really got our fingers burnt. But those of us who sort of held on, we've seen some fantastic returns, and that brings me to my next question and sort of connected to the markets, Chintan, because it's been a pretty fabulous run. I mean, calendar year 23 that we ended on. 24 has seems to be a slightly, as you said, there've been some withdrawals by FIIs. So in terms of really where my as an investor who was say invested in 23 has seen some fabulous returns, would you advise him or her to perhaps book some profits, but including in a category of funds such as these as well, or would you say just hold on, stick to the course, stick to that 5 year horizon at least?
So the good news is that if you're invested in any of the hybrid categories, especially the balance advantage fund or the multi-asset fund, the fund management team would do the job of ensuring that they are reducing your risk in case the market gets overheated, or at least being in spaces which probably are not overheated. So I don't think you need to worry. And more importantly, what you mentioned that it's been a great 2023 or a great year, I'd say it's been actually a great decade for India in terms of 2013 2023. And if we go back to what happened in Japan between 1970 and 1990, what happened in China between 1995 and 2015. We're probably into 10 years of India's 20-year journey of growth. So 2023 to 2033 would also be good in terms of India's economic growth, and that should eventually reflect in the markets as well. So yes, the temptation to book profits or take money off the table would be there, and it's not a bad idea in case you need the money in the next 2 3 years for objectives or goals which are fully set. Say you need money to send your children abroad for studies, or you need money for someone's marriage in the family, or a down payment of a house. You may want to basically book some gains if the goal is already there. But if the goal is 5 years down the line, then probably it may make sense to remain invested. Thank you.
Okay, so it really all depends. And I think that's an important lesson for all our investors and viewers who are watching. It really depends on your own sort of personal targets in terms of your fund requirements, but always better to stay invested because you will see then the kind of multiple returns that one has been getting used to seeing in the equity markets. Right. Remember, for all of you who are watching this segment and this fascinating interaction with Chintan, you can send in your questions. And in fact, we do have a few questions coming in at this point in time. And Chintan, I'm going to take the liberty of taking one across to you. Now, again, the question being coming in from a viewer, and thank you for this question. Who should consider investing in multi-asset allocation funds, especially from, from the perspective that you've got the start of a new calendar year. You've also got the fiscal year ending in March 31st, and you've got the budget in between.
So I think it's a category where anyone who's looking to start a SIP, anyone who's looking to do a lump sum investment for more than 5 years, they can definitely look at it. And like I said, there is no restriction on whether you are a new investor or a seasoned investor. Of course, for seasoned investors, there are other alternatives which they may want to probably explore in the fully invested category because they understand the markets a little more. But for new investors or investors who are generally conservative in nature, especially in the kind of markets that we've had, where the valuations are no longer cheap, you may want to start with a multi-asset fund, be it lump sum SIP, that is not a problem. And then, as you probably understand and the markets, teach you over a period of time how they work, you can expand the product bouquet which you have. But for any first-time investor or a conservative investor looking to build investments, you have money you need to invest. Multi-asset fund should be the first port of call in terms of your investment journey. Thank you.
Right, because it was said, and this was something that we were taught as journalists, is that as your age profile, as you age, essentially, the equity portion should come down, and the debt portions should sort of increase in order to increase maintain the stability in your returns. Is there sort of a rule of thumb now that you've got so many? Honestly, it's a bewildering array of categories of mutual funds now.
Yeah, so if we look at, and this is from personal experience in terms of meeting those who are nearing retirement age, I mean, I met two or three individuals who are nearing retirement age. The thing is, their fixed income component comes from normally the PF trust or the payouts that they're going to happen if they work for 15, 20 years. So that is a sizable chunk which is they consider fixed income. So they are quite happy to continue with their equity investments. And if their equity investments are in the balance advantage fund category or the multi-asset fund category, they're more than happy to continue with that. So I think from a investor standpoint, it is something which if you are also looking at planning for a retirement, or if you want to invest, you can pretty much invest and there should not be a problem holding it, because from an allocation perspective, if you look at it, you do get a sizable chunk of your PF and your savings, etc., at the end of your tenure, and when you're retiring, you'll end up getting that. India equity allocations are always much smaller because if you've not basically inherited a lot of money, most of the time when you are younger, you're basically paying for the EMI of the house, or the children's education or marriage, etc. So you not build a very large equity corpus. Very few who are lucky have built it. So if you built a equity corpus, continue with it because the balance will be taken care of. And as long as you're invested in balance advantage fund or multi-asset category, it's not a stress. If you're invested in more riskier categories, let's say, which are in the small cap, mid cap, or sectoral categories, you may need to rethink. But in these categories, you don't really need to worry about.
In fact, we do have a question just coming in about retirement planning. Just elaborate a little bit more. If I am planning for retirement, then in that case, what should my portfolio be looking like, and how much of that allocation should be towards, say, a category such as this, the multi-asset allocation fund?
So typically, what we've seen work well for investors or other prospective retirees is that whatever the money they need from because obviously the source of regular income is going to shut, so they need cash flow requirements. Typically, for the next 3 years, whatever cash flow requirements they need, we typically park it either in the equity savings category or the equity arbitrage category, and then do the SWP from there. That's the first 3 years. And after 3 years, say up to 5 years or 6 years, the money can go into the multi-asset category. So whatever they need beyond that, that will be in multi-asset category or balance advantage fund. And the real long-term money which is left, because you'll have to see what are the goals, what are the liabilities, and if you have responsibilities for which you will need to basically give money. If none of that exists, then if you have money which is more than 7, 8 years, that may go into fully invested equity funds. So that's the kind of layering which typically we found works well for retirees. And in that context, the multi-asset fund and the balance advantage fund category are very popular for those who are having that 3 to 7 year investment horizon, and they want to invest there with the view that then that will start giving them money in terms of SWP. Because the first 3 years you typically park it in the least risky arbitrage fund or say a debt fund or whatever that suits, so that you don't have to worry about the volatility of the market when you're pulling out money from the first 3 year bucket which you need in terms of your cash flow.
Right. So, that's some great advice. And again, a question comes on tax implications. And the question is, are there tax implications for investors in the multi-asset allocation funds? We touched upon this briefly, but clearly, some more elaboration is what the viewers want.
Sure. So, in terms of how mutual funds work, as most investors would know, that when you put the money, and after that, till the time you take out the money, there is no taxation implication on the investor. So, when you put the money in any of the mutual fund schemes and then you allow it to compound, grow, whether it's a debt scheme, equity scheme, international scheme, or a hybrid scheme, there is no tax implication on you as an investor, right? Now, when you are taking out the money, that is when the tax implication will come into you, and that depends on, of course, the capital gain part which you made, which category of investments which you made, and what is the time horizon. As I had explained earlier, probably you can, I'll just refresh what I had explained in a much quicker manner, that there are three categories of investments which happen in terms of taxation. One is equity taxation. So, from an investor standpoint, if you are invested in a multi asset allocation scheme which has equity taxation, you basically do not need to worry about the equity tax. I mean, worry about the taxation till the time you redeem. And when you redeem, if you completed more than 1 year, then whatever is your gain, you pay 10% and some surcharge on that. That's the implication of tax which will come on you as an investor in multi-asset fund. In between, whatever the fund management team buys, sells, whatever dividends come, whatever is the accrual which comes from the debt, all of that keeps getting added onto your NAV. And finally, when you redeem, as in when you need the money, that's when the tax implication will come to you as a multi-asset fund investor. If it's an equity multi-asset fund which has equity taxation, it will be equity tax which you will pay as an investor. If it is a hybrid rather model which has indexation benefit, then you will pay the taxation according to that particular category. So as an investor, you need to know which category of taxation does the multi-asset fund come into, and then only when you redeem, you will be liable to pay any tax on the gains which you have. Thank you.
In fact, just elaborate a little bit more, because there are many multi-asset allocation funds, as you said. So, as an investor, one I should pay close attention, depending, of course, on my own investment and returns requirements, in terms of which category of funds the multi-asset fund allocation falls into. Is that something I should particularly pay attention to?
Yes, correct. So if you look at as an equity taxation product, you're paying 10%. So most investors who are in the 20% or 30% tax bracket, for them this becomes a good potential investment which has equity taxation for those who want the indexation benefit from their portfolio, or who like the idea of having one third, one third, one third in equity, debt, and commodities. It can also be an investment decision from an investor that I want one third, one third, one third, and this suits me well. Then you'll get the benefit of long-term capital gains. Rather, you'll get the benefit of indexation if you hold it for 3 years. So, but within 3 years, if you take out money in that, it will be marginal tax. So equity taxation is the more preferred area generally as we see. Some people may want to have the hybrid taxation, which is essentially the indexation benefit also. And so I would like to say that pay attention to where you're investing in terms of what is the underlying multi-asset fund and what is the taxation, and then probably take help from your tax advisor or your suitable financial advisor to choose where you want to be. The taxation impact will come only when you take out the money, but the
Right.
decision to invest where will have to be taken first, knowing where the taxation or which fund has which kind of taxation. Thank you.
Right. Those are some important aspects to keep in mind. And, we would like to discuss so much more, including, Chintan, your view on the markets. I know you said that you're very optimistic, especially given the kind of economic forecast and growth that we've seen in the last quarter, and also the forecast for the coming year and the fiscal. Any sort of parting words you have for our investors in terms of what kind of market returns they can expect, equity market returns?
So if we look at India, of course, as a country, it's been growing for more than 30 years now, 32, 33 years since the economic liberalization of 1990-91. And we've never looked back as an economy, and probably the next 10 years are also going to see a growth in the Indian economy. To participate in the economic growth, obviously the companies will sell more, they'll have more profits, and ultimately their market capitalizations will reflect that. And for you to participate in India's growth is something which equities allow you. And many Indians have already started doing it, but probably we as Indians, at least in school and college, are not taught that how is equity investing done, or what is the best way to do it. It is changing now with more and more awareness which is happening, but the only thing which I would like to say is that we are seeing growth in India in the next 10 years. And with the growth in India, you will see growth in Indian equities as well. But if you get a product which is giving you equity, debt, and commodities also, because commodity markets also have their cycles, and gold hasn't performed in dollar terms for 13 years. So if for 13 years it has not performed in dollar terms, with the expectation that inflation is going to be high in the global world because of easing monetary conditions going ahead, then gold also becomes a good investment. So as an investor, while we cannot predict what is going to happen, what we know or what we can sense is that the optimism in India is there. We as a country are going to grow. To participate in that, we need to have equity allocation. To participate in gold, multi-asset funds have allocations. And if you're getting all three, which is equity, gold, debt, and even REITs in one product, why not start doing an SIP at least, if not a lump sum? So, to all the investors who are watching, start your journey of SIP, if not lump sum today, and see it over a period of time, adding value to you and your portfolio, more importantly, adding to your family's financial security in the long run. Shortcuts don't work in equity markets. If you keep the money for long run and the fund management team does a good job of managing the fund, then you should be ultimately be the beneficiary of India's growth in the multi-asset category funds. Thank you.
Right. Thanks, Chintanarya. It's been such a wonderful learning experience, and clearly reiterating that point that India is part pretty much of every global investor, and it should be part of every Indian investor, including the retail investors' portfolio as well. And the multi-asset allocation fund addresses some of those requirements. You get diversity in terms of diversification of capital into so many asset classes, including, say, a gold or REITs, as well as mitigation of risk. You can get steady returns. And we, of course, heard at length about the taxation benefit. So consider such an allocation of funds when you go ahead with your investment plans for FY24. But till then, thank you so much, Chintan. All the very best. Take care. And we really hope those predictions come true and our equity markets and, of course, India as a whole continues to fire the way that it has been. Thank you so much for joining us.
Thank you so much. Always a pleasure, and look forward to seeing all of you soon. Thank you.
Right. And thank you for joining us on this session today on Money Control.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.